Assalamu alaikum. Welcome to Media. So few of you have asked me to make a video on just stock market for dummies, stock market for beginners. So let's talk about that very briefly. I'll try to make it quick. There's a lot to cover, and I don't think it is possible for me to make a video, even an hour-long video, and cover everything in it. So I will try to touch the whatever I think is the most relevant um stuff on this topic. So let's before we dig into this, let's see what happens with the money over time. What's inflation? Inflation is that your money, if you put your money under your bed and just leave it in a bank, whatever, it's going to lose a lot of its value over time. You can look at the inflation rate online, depending on whichever country you are in. If you just Google search U.S. inflation rate, it generally varies between 1.8 to 2% per year. So what does that mean? That means if you bought something for $100 5, 10 years ago, now it's going to be 120 or $125, depending on the rate of inflation in the past 5 to 10 after 5 to 10 years. So that means your money is inherently losing its value, right? So what's my understanding of money? Money is just a paper, and that paper loses its value over time. Money is not an asset. So, what is an asset? An asset is something that does not depreciate in value, it appreciates in value. Now, it could be real estate like a house, it could be uh, stocks, or it could be something very unique or rare. But the point is, there should be demand and supply, in the sense that there should be more demand than the supply, so the value tends to keep going up. So, that's an asset. Money, unfortunately, I don't think it's an asset because it depreciates over time. So now the next question is, what is an investment? An investment is the money you pour in to buy something. Then what is the capital gain or gains in general is the money you gain from that investment. So let's say if I buy a house for $100,000 and I sell it for $150,000, my investment was $100,000. $50,000 were my gains on it. If you sell it for a loss, it's a loss. Okay, that's investment. Now the question is, what is a share? Let's say me, Umar, I build a company and I name it Umar ABC. Now that company is worth $500, and I break those $500 into 100 shares, 5 shares each, right? Now that means each one of the share is $5. Since there are 100 shares, I am the owner, and let's say I end up taking 50 shares. So I have $250 in the company. But the rest of the 50 shares for $5 each, now they're available in the market for you to buy. If you believe in me and if you think my company is going to perform better than the rest of the companies in the market, you buy my share for $5. If I really did better over time, then the $5 are going to jump up in the sense that it can become $8 or $10 in the future, depending upon how my company is doing. If my company does not do well, then your $5 is supposed to go down in value. Let's say my company is doing very well, the value of my share is going up, but at the same time, I have a lot more money and a lot more profits, and I don't know what to do with that. So I can say, okay, for every share, I can give you a dollar back because I made, let's say, $50 in profit, and I'm trying to give a dollar back to each one of the shareholder. So that's money that comes back to you is called dividend. How do you buy a share? You need to get a brokerage account, so you can use whatever bank you have. You can call them and ask them that you need a brokerage account, or you can just Google or go to your app store, iTunes, and download the app for any top online brokerage account. A lot of the big ones right now are Fidelity, Vanguard, TD Ameritrade, any one of them. How do you buy shares? You just um, put some money from your bank account into the brokerage account, and then you go to the orders, place an order, and buy the shares. So how do you decide? Uh, how do you like which shares you need to buy? This is very challenging. The thing is, there's a lot of either you can do guesswork. A lot of people are buying this, and you just hear people talk about stuff, and you just buy whatever other people are buying, or you can do your own research, which demands another completely separate video. You look at balance sheets, you look at companies, you look at their finances, you look at the pictures, and you're like, okay, this seems to be a good investment. The company seems to be undervalued, appropriately valued, or overvalued. Or you look for the next big growth companies. Like I said, this is a completely separate video, which I would probably do at some point of time. So that process in itself is called active stock picking. Now let's talk about what is a fund and what is an index fund. Fund is something, let's say, rather than you picking individual companies, you uh, have somebody else, let's see me, I buy 10 companies, right? And now I have a fund of 10 companies. Now I'm going to say, okay, guys, I'm going to charge you guys 1% fee uh, to manage this fund, and I'm going to break all this fund into 100 pieces. And you can buy one piece each, or one stock, or one share each. That is a fund. Now, the problem with these funds is a lot of times that the expense ratio, which means the fee that you pay to your manager, is it's pretty high. It's 1 to 2%. So a lot of times, it's not worth paying that. In finance, they say uh, the the less money you pay to your financial advisor, the more money you keep. So uh, the money that don't you don't make money when you give me money. So the point I'm trying to make here is, like, if the expense ratio is low, you get to make that more money, and that money is compounded over time. So it's not advisable to have funds with very high expense ratios. Yeah, somebody can use an argument that what if the performance of that fund is very, very good and it's the best financial advisor ever? Yeah, well, in that case, it's probably okay, but how would you know? Past performance is not in any way indicative of future performance, so that doesn't really help. Now let's go to the another special types of fund investing. It's called index fund investing. What does that mean? What that means is, rather than having a person manage your funds actively, there's more like a computer or computer algorithm that's managing your funds. And rather than me deciding which 10 companies I want to buy, you use an index to do that. Let's say you use S&P 500, which are top 500 companies in the US, or you use NASDAQ, which is as the top 100 software companies in the US. So now the computer is automatically buying those top 100 companies for NASDAQ, or top 500 companies for S&P 500. And then you form this fund and break it into tiny portions, small stocks, shares, and now you buy those. What does that do? Before we talk about that, let's talk about diversification. What is diversification? Diversification means that you're not putting all your eggs in one basket. So if you're putting $100 into your investment, you don't put all $100 in one company. You break your investment into 20 different pieces, with $5 going into each company. This way, if one or two companies go bankrupt, then you still have most of your portfolio intact. In that sense, that, okay, let's say two of the companies went bankrupt, you didn't lose all your money. The $100 is now 90, but it's not zero. Is it possible for it to go to zero? Um, Yes, absolutely. If you pick horrible stocks, it can totally go to zero. That's why active stock picking is risky. So, why is index fund investing considered better? The reason it's considered better is because of diversification, or even over diversification. In S&P 500, you're putting your money into 500 different companies. In Nasdaq index fund, you're putting your money into 100 different companies. So, what is the likelihood of an index fund going to zero? It's almost non-existent, because let's say that if you buy an S&P 500 index fund, that means all the top 500 companies in America are going bankrupt for your investment to be zero. So that's like next to impossible, right? All the companies you know about, they're all going down. Apple, Facebook, Google, Zoom, Amazon. They're all going to be bankrupt at one single time. All of them have this happening together. I, you get the point, right? So now let's talk about risk assessment. The point is that we talked about diversification, and we said that diversification protects you from the risk, so from the volatility and risk. So because index fund investing is highly diverse, it's less volatile, so the risk is way less. as compared to active stock picking, in which you're picking a set number of stocks, that is extremely volatile and very risky compared to that. But at the same time, that also means that you will get exponential returns if you pick the right stocks. But how do you know? Nobody can foresee the future. It's all guesswork and speculation. So you have to maintain that fine balance. And I'm personally, if you're new to this, I won't recommend you doing active stock picking. Just buy good index funds, which could be S&P 500 or Nasdaq, either one. I personally think Nasdaq has better returns in past 25 years. That might be better for you, but just do whatever you're comfortable with. Uh, then the next question is, when should you get started? As soon as possible, because all the money that you have in your bank is losing its worth. Uh, so you should all the extra money that you have, you should start investing ASAP, because over a span of 2 years, 5 years, 10 years, that money is gonna be way less in worth in the future. So how do you decide if you have enough money? I think the two very important things are that you need to have your emergency funds, that you know you need to make sure that you have at least 3 to 6 months of your money saved, that can survive you for 3 to 6 months if you get laid or something like that. Once you pile that money in your savings account, then you use the rest of the remaining money, whatever you have, and put it in your brokerage account. One thing that I would suggest: don't put all your 100% of the money at the same time. Always have 10 to 30% of the cash, so that if there is a market crash, you can buy heavy in future. Uh, how much money do you need to get started? You can buy stocks even with $1, $2. They're penny stocks. So uh, what I would say, start investing. $100 sounds like a good number. $50 to $100 save. Try to save $50 to $100 every month, and then see how much you can save. If you can save more, you can invest more. And next thing that I'm gonna mention on that topic is dollar cost averaging. Dollar cost averaging means that you're not trying to time the market or uh, buy a set any active stocks. What you're trying to do is you're using index fund investing. So let's say Nasdaq is QQQ, or any S&P 500 index funds, and putting a set dollar amount of money every month, every week, or every other week, something like that, whatever frequency you decide. So what that does is the market is always fluctuating, going up and down, up and down, up and down. When the market is up, you buy less number of shares. When the market is down, you buy more number of shares. If you do that consistently over a span of multiple years, um, you make pretty good amount of money, because your investment uh, was averaged out. So when the market was up, you bought, let's say you invested $1,000, you bought 10 shares. Then the market came down, but you still invested $1,000, and you bought 20 to 25 shares. Now the market is super high, you still paid $1,000, but you got 5 shares. Now, on a span of multiple years, multiple months, when you average it out, you have a pretty good um average cost, because you bought shares at the rock bottom as well as the peak. It averages out, and that takes a lot of stress, and emotions out of investing, because two of the biggest curses in in investing is FOMO, fear of missing out, and panic sell. When something is going high, 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 you're just buying, and it might be just peak before the next crash. So that it's very tough to control your own mind, your own emotions. So I think dollar cost averaging really works to keep your emotions in check. And then the next one is panic sell. When market price crashes, everybody's super worried about their money, and they're trying to panic sell. That is the wrong time. That is the time to buy. Don't ever panic sell. You just need to hold. Never sell for a loss unless a company is going bankrupt. You want to hold and wait for it to go up. All right, now second last thing I want to talk about is that active stock picking versus index fund investing. What is better in the long term? Like I briefly touched previously, that index fund investing is better. Warren Buffett, who is the biggest investor of all times, has said it multiple times that if anybody gives him $100,000, he's just going to put it in an index fund, and that's what he recommends to all the beginner investors. In 2008, he placed a bet that if there is any of the hedge fund manager, if they can get a return better than the index funds, he will give them $1 million. That never happened. 10 years passed, and 10 years later, he won the bet and he got the money. So you get the point. You get the idea that over a span of multiple years, it's very tough to beat the index funds, beat the market. So last thing is I'm going to talk about is capital gains. So capital gains means that we talked about this initially. You use your investment and whatever money you make from that investment. So you put in $100,000, that 100,000 becomes 150. So your capital gains is $50,000. So the taxes right now, as of Feb 1st, 2020, uh, for short term, and what do I mean for short term? You bought something and you sold it within 12 months. The taxes are the same as whatever your money you're making. If you're taxed at 30% bracket, that's the tax that you will be paying. If you're taxed at 40%, 25%, whatever, that's the money you pay. If you are in long term, if you're doing a long term trade, that means you're holding the stock for 12 months or more. In that case, you will pay a different number of taxes, a different amount of taxes or percentage of taxes depending on how much money you make. If you make less than 75,000, it's going to be zero. If it's between 75 to 422,000, then it's 15%. If it's more, if you make more than 422,000, it's around 20,000, 20%. You can Google this information. Like I said, it's long-term capital gains tax. More than 422 is 20% of your capital gains. Uh, 70 something to 422 is 15%, and less than that is 0%. So I hope this video helped you. If it did, please like it, share it with others, subscribe to the channel. Like I always say, never give up, never lose hope. Bye.